In this pod, we'll talk about what's meant by cash flow and how businesses manage their cash.
Cash is one of the most important things to a business. A business can be hugely profitable, but without cash, it can't pay its bills or buy new stock. For example, if a car dealer buys a car for £10,000 and sells it on for £12,000, they've made a significant profit, earning an extra £2,000. But if they make the sale on credit, it means they get paid later. So despite having made a profitable sale, they don't have any cash. This means they can't pay their bills, they can't pay their employees, and they can't buy more stock, which in turn means they have nothing else to sell.
So cash is hugely important to a business. If this continues and a business can't make sales and fails to pay its bills, it will go insolvent. This is when a business doesn't have enough funds to pay its bills. This is also what's meant by working capital. Working capital is the day-to-day money a business has in order to pay for running costs.
A business needs to manage its cash carefully, and this is done using a cash flow forecast. Any forecast is a prediction of what will happen, like a weather forecast. So, a cash flow forecast is the same idea. It's prediction of cash flow. And, just like the weather, it may not always be correct. A business can also do a cash flow statement, which looks at previous cash flows.
For example, if you start off with £5 in your wallet, borrow £20 off your parents, and spend £10 while you're out, how much do you end up with? Well, you have £5 to start, get another £20, so now you have £25. Then you spend £10, so £25 minus £10 leaves you with £15. This is the same as cash flow in a business, just on a smaller scale. And if you were writing this up professionally, you'd give each item a proper title.
The £5 you start with is called an opening balance. The £20 you get is called an inflow, and the £10 you spend is called an outflow. The £15 you're left with is the closing balance. There's just one more calculation, which is inflow minus outflow, and this is called net cash flow. Remember, inflow is the money in, and the outflow is the money out. The clue is in the name, really. Net is kind of like a big fishing net, catching all inflows and outflows.
So, to recap these terms, opening balance is the money you start with. Inflow is money coming into the business, and outflow is the money leaving the business. The net cash flow is your inflows minus your outflows, and closing balance is the money you finish with. This can be calculated by your opening balance plus net cash flow. In our previous example, the closing balance was £15. This then becomes the next opening balance. Think about it. If you finish the day with £15 in your wallet, when you go out the next day, the £15 hasn't changed. So whatever you close one period with is the opening balance of the next period.
Cash is really important to a business. Remember, without cash, the business can't pay bills or buy more stock. In our example, you'd say that the business had a positive cash flow as they finished the day with more cash than they started with. If they'd finished with less money, it would be a negative cash flow. It doesn't mean that the business has made profit or loss. It simply means they have more or less cash than the start of the day.
If the business is having negative cash flow, they can try and fix this. For example, if they know they're going to have a short-term cash shortfall, they could get an overdraft to cover the shortfall. An overdraft is a relatively small amount of money that you're able to borrow from the bank each month. A company does have to be careful using an overdraft regularly, as the moment money goes into the bank account, the overdraft is the first thing that's paid off. If you then use it again and again, you start to rely on money that isn't yours. Some overdrafts also have charges, so it's always worth bearing in mind that although the overdraft option is there, it's not the best way to manage a regular shortfall.
Another problem could be that a business is spending too much on stock one month. In this case, they could use more trade credit to accommodate this. Trade credit is where you get the stock required, but don't pay for it until later. Some companies even allow you to reschedule a payment, as they'd prefer to wait than not be paid at all. Failing that, a business could try and get cash quicker, so they could ask their customers to pay any money owed. Or, sometimes the best solution would be to try and increase revenues through more sales promotions to sell more products.
So even if a business knows they're going to have periods of cash flow shortfall, if they plan correctly and manage their cash flow, the business can still be successful. Cash flow has to be carefully managed to prevent business failure, which in business terms is insolvency.